Um, Hello, I'm Dara Burns. I'm the chairperson of the Finance and Investment Committee, and I'd like to thank and welcome everyone for attending the Finance and Investment Forum today. Just to remind everyone that the webinar is being recorded, and we hope to post it to ActuView and YouTube after the event. The Q&A session is also being recorded. Before we start the presentations, I'd like to just give a brief update on the work of the Finance and Investment Committee over the course of the year. The Finance and Investment Committee, we've continued to update the Society Finance and Investment, Finance and Economic Assumptions paper, which feeds into the production of the relevant ASPs and is designed to ensure consistency across the various ASPs produced by different committees. Currently, as part of that work, what's currently under consideration is the appropriateness of continuing to maintain an historical data set in light of sort of rival sources of historical financial data. And the committee very much welcomes input from members and other committees in terms of the usefulness and usability of the committee's historical data set. Currently, the committee acts as a resource for any ad hoc queries from other committees, and we actively welcome any such referrals. Committee members have contributed to a number of working parties over the course of the year, including auto-enrollment and sustainability and climate change committees. The committee also organises regular CPD events throughout the year. We specifically attempt to address the following topics: ESG investment considerations, renewable infrastructure investments, the impact of regulatory changes, and any other areas of topical interest. One development is that following the production of the emerging risk template is that we'll use discussion on emerging risks, which are to the society as a whole and actuaries in the profession, as a format to drive future CPD programs as well. I'd like now to kick off the initial presentations. Just as part of the format of this, questions can be asked at any point. Participants can submit questions through the Q&A portal, which appears at the bottom of everyone's screen. That can be posted alongside your name, or if you wish, you can post anonymously. Questions can also be asked through the raise a hand feature, and attendees can signal their intention to speak by using this feature, and then that can be asked on a live basis. And then just to remind attendees that once you've registered with your full name, we'll have a record of your attendance. There's no longer any need for verifiable CPD in the Society CPD scheme, but we appreciate that other organisations may need that. So first of all, the first speaker we have today, and very much like to welcome, is Kieran McQuinn, who is a research professor in the ESRI, who works on the quarterly economic commentary on macroeconomic and housing-related projects. His research interests are in the macro financial and economic growth areas. He spent over 11 years working in the Irish Central Bank, where he had management positions in the research and financial stability areas. Kieran has a PhD in economics from NUI Maynooth. He has served on the management committee and the council of the Economic and Social Research Institute, and he's currently adjunct professor of economics at University College Cork and Trinity College Dublin. So I'd like to pass it over to Kieran, and I very much thank you for presenting to us today.
Thanks very much, Dara, and hello to everybody, and thanks very much to the Society for the invitation to present at your event here today. So what I'm going to do is provide an overview of the macroeconomic outlook for the Irish economy, how we see it evolving over the next 12 to 18 months. So maybe if we move on to the next slide there, thanks very much. And so the take-home message, I suppose, really is that we expect the Irish economy to register growth, relatively strong growth for the present year, but also growth into 2023 and indeed over the next 12 to 18 months. And that's notwithstanding the significant headwinds that the Irish economy is set to face mainly because of global pressures. And so when we think about the factors that are contributing to growth and how we see the economy evolving over the next 12 months, kind of the crucial areas really, and some of the factors which stand out are the rapid recovery in the labor market, which we've observed since the pandemic, the very strong performance of certain sectors in the economy. So really, if you dig down deep, you can see that the key drivers of growth and sectors of growth in the Irish economy at present are in areas such as the ICT and pharmaceutical. And these sectors have managed to remain relatively unaffected by some of the global pressures that we've seen really since the pandemic. And these are what are driving a lot of the employment growth, value added in the economy, and indeed the trade performance of the economy. In recent quarters, we've seen strong investment, and this is kind of modified, what we call modified investment. So it's underlying investment in the economy as opposed to some of the headline investment figures we see, which are more tied in with multinational related activities. And we see strong performance related to that in terms of the taxation receipts, which have accrued to the Exchequer. And those receipts, of course, have been used by the government, are being used by the government, if you like, to try and safeguard family incomes and indeed businesses from some of the energy expenditures which they're likely to incur over the next 6 to 9 months. And they underpinned, if you like, the strong Exchequer receipts underpinned the fairly large budgetary package, which was announced just last week by the minister. So other key issues, I suppose, in terms of how we think about the outlook over the next 12 to 18 months are how households use some of the savings that they have accrued over the last period of time. So households in Ireland, like households in many countries during the pandemic, built up significant savings levels. And so a key question for us going forward is how they use those savings, particularly in light of the challenges they're set to face as far as consumption in particular is concerned. And as I said at the outset, one of the other big issues, of course, at present is the global conditions and the fact that most and a lot of our major competitors are forecast to experience a recession over the next period of time. So that clearly is going to have an impact for the domestic economy. Okay, so maybe the next slide, thanks. So if we look at recent economic performance, so when we look at economic performance in Ireland, we have this issue that I'm sure many people are aware of, which is that GDP, which is the common measure that's used across countries, gross domestic product, tends to be inflated in an Irish context by multinational related behavior. And so when we talk about GDP, very often that's inflated by a certain number of firms in the country. So what we also do is we use an indicator called modified domestic demand, MDD, and that consists of consumption and modified investment, underlying investment in the economy. And that gives us a good insight into the underlying pace of economic growth in the economy. But if we look at GDP, we can see, and in this graph here, we've compared Ireland with the euro area. And you can see how well Ireland has performed in recent times. Even during the pandemic, we had strong growth in the economy. Now, that was related to certain sectors in the multinational part of the economy. But the economy overall continued to grow in the last few years. And as you can see, that compares with the performance in the euro area. If we look at the next slide then, which is what we call a nowcast of modified domestic demand. So nowcast is a kind of a modeling tool that's used by a lot of forecasters in that it allows us to estimate where the economy is at right now. So most economic data comes at a lag. So when we're talking about actual performance, we're very often talking about what happened in, say, Q1 of this year. The nowcasting approach allows us to talk about what's happening right now in the economy. And our estimate for modified domestic demand is right now in the Q3 of the present year, the economy is growing at around 4.5%. So that's a fairly strong performance given everything that's occurring right now. Now, we do see that pace of growth slowing as we approach the end of the year, and we see it slowing further into 2023. But, you know, there is still a strong dynamic and underlying rate of growth in the domestic economy at present. Okay, in the next slide, we look at the drivers of growth. And so these are the key areas that we typically, you know, when we're looking at how the economy is performing at a point in time. So we tend to look at consumption, both private and public, investment, and then the trade sector in terms of how exports and imports are performing. The significant increase in the savings ratios I outlined at the start has helped to underpin a lot of what's happening in terms of household consumption. So even though households are facing very significant rates of inflation, which typically would tend to have an adverse impact on their consumption, the fact that they've built up substantial savings does mean that they have a certain buffer. And when I talk about households, of course, I mean in the aggregate. Clearly, there are some households that don't have these kind of supports, but in general, households have a buffer that allows them to deal with some of the adverse shocks, if you like, that their incomes are facing because of the cost of living issues. Exports have grown very strongly over the recent period of time, and that's again relatively sector specific. So it's tending to deal with the fact that the ICT and pharma sectors are performing very, very strongly. The pharma sector in particular performed very strongly during the pandemic. It was mainly related to the pandemic. So that gave the economy a significant boost in terms of growth. And as I said earlier, modified investment, which is investment in areas like plant and machinery, housing completions, these areas have experienced strong growth in recent quarters, and we expect them to continue to show some degree of growth into 2023. In the next slide, I'm going to talk a little bit about the traded performance of the economy. Obviously, there's the overall traded performance, and as I said, areas like pharma and ICT are performing very, very strongly with significant year-on-year growth in terms of exports. However, another issue clearly is how we're dealing and how our trade with the UK is going. And I'll talk a little bit about the UK later on in terms of some of the recent shocks that economy has experienced. But you can see that we're registering quite a strong trade surplus with the UK there recently. Now, some of that is to do with Brexit. The UK hasn't been imposing the kind of checks on exports into the UK economy that they signed up to in terms of the withdrawal agreement with the European Union. And so therefore, whereas the European Union obviously has been imposing some of these checks on UK exports into the euro area. So clearly we have a situation where we're living in a slightly surreal world where our exports are still benefiting and are still trading with the UK as if nothing has happened. But clearly our imports from the UK are being affected by the agreements that have been reached with the UK as far as Brexit is concerned. So if the UK were to fully implement some of those agreements, then clearly there would be an adverse impact on Irish exports and European exports into the UK market. But overall, we continue to see and expect a relatively good performance from the traded sector in 2023. However, there will be some moderation, particularly in light of the global conditions that I talked about earlier in terms of the expected downturn in some of the key economies that we trade with. In the next slide, I'm going to talk a little bit about the labor market, and no sector probably best exemplifies the strength of the Irish economy than the labor market. As you can see, during the pandemic, the unemployment rate shot up. At one stage, it was up near 30%. On an annual basis, it was 16% in 2021, but it really has fallen very sharply since then. So the unemployment rate in 2022 is likely to average around 4.8%. And next year, we believe it's going to really fall down to around 4%. And you're seeing that's going side by side with very strong increases in the participation rate and strong employment growth. And as I said, some of that employment growth is going back to the pharma and ICT sectors. The fact that we're going to see such low unemployment rates next year will probably result in a strong upward pressure on wages. So we expect to see wages pick up quite a bit next year and into the following year. And that reflects the fact that we're at historically low unemployment rates as far as the Irish labour market is concerned. If we go into the next slide, we see the kind of global conditions that we're set to experience. And really, global uncertainty and rising costs are affecting sentiment both domestically and in an international context. And clearly, that has a big impact as far as the domestic economy is concerned. And it's why we expect the pace of growth into next year to moderate. You can see the savings ratio, and you can see how elevated that ratio is, up at around 20% even still. It peaked up near 35% during the pandemic. But you can see if you go back to 2019, that typically the savings ratio in an Irish context is somewhere around 10%. So you can see it still is at 20%, still is at a very, very high rate compared to where it traditionally tends to be in terms of savings levels in the economy. It's for that reason that we're still anticipating growth in consumption next year, even though we do expect to see a continuation in some of the high, in some of the inflationary pressures that we've recently been experiencing in the economy. In the next slide, as far as investment is concerned, again, a crucial distinction in terms of investment in the domestic economy is the difference between the headline levels of investment, which oftentimes can be very much influenced by multinational related activities, particularly in terms of patents and the like, and underlying investment or modified investment. The modified investment typically tends to consist of things like housing completions, plant and machinery, and indeed even data centers and the growth in data centers in the domestic economy in recent years has been a key driver of investment in that category. As far as the rising inflationary pressures are concerned, clearly that is going to have an adverse impact on investment. And that's because we expect to see continuing upward drift in interest rates as central banks try to deal with those inflationary pressures. And of course, rising interest rates will have an adverse impact on investment. But nonetheless, we still expect, particularly because of developments in the housing market and the recent strength of underlying investment in the economy, we still expect that there will be some growth in investment as we move into next year, and indeed strong growth in the present year. In the next slide, I'm going to talk about the strong performance of some of the key fiscal metrics. So we've seen very, very strong growth in certain key tax headings over the last year. In particular, we've seen income tax and VAT grow substantially as the economy has kind of rebounded and come out of the pandemic. But of course, the other area where we've seen very substantial increases in tax receipts has been in corporation tax. And you can see that year on year for the year January to August, corporation tax receipts increased by nearly 70%. That was up on very strong growth in previous years. So we really have seen very strong and unprecedented growth in corporation taxes. There are certain question marks about the sustainability of that as we move forward. And it's hard to assess the sustainability of it because clearly we don't have access to the kind of the granular level data that one would typically use in terms of assessing that type of issue. But we do applaud, for instance, the recent measures announced in the budget, such as the rainy day fund, where a certain portion of the corporation taxes are going to be diverted. And we think that that's a positive feature, given the question mark around how sustainable the kind of increases are likely to be. The overall consequence of the strong fiscal performance, though, is, as you can see in terms of the headline fiscal metrics, so things like the debt to GDP ratio and the general government balance, we expect to see a positive government balance this year, even with the budgetary package announced and even with the money being diverted into the rainy day fund. And indeed, we expect to see a positive government balance next year. What that means is that the key fiscal metrics, debt to GDP and debt to GNI star, are likely to continue to fall, which is a positive development for the economy. But it also does mean that the government, even after the package that they've announced in the budget, that they still have some fiscal headspace if they wish to introduce new measures in 2023. So that is some consolation to have if prices and costs continue to escalate into the new year. In that respect, in the next slide, I'm going to talk a little bit about the inflation outlook. And clearly everybody has noticed the surge in inflation over the past period of time, the fact that that's been mainly driven and related to energy issues and to a lesser extent food prices globally that have risen sharply in light of the post-pandemic surge in demand and the issues around supply chains. But of course, the situation in the Ukraine since February and March of this year have exacerbated those pressures. Households are experiencing, high rates of inflation, but it differs across households. So particularly households in low-income families typically tend to face higher rates of inflation, and that's to do with the composition of their expenditure and their basket of goods and services that they spend on, in particular because they have a higher proportion on issues such as energy and basic foodstuffs, and these are where the rates of price increases have been higher. So clearly you're seeing different inflation rates across the economy. We expect to see inflation average out at just over 8% in the present year, and we still expect to see a significant rate of inflation in 2023 at around 6.8%. So that will have an adverse impact on household incomes in terms of people's real incomes are likely still to decline this year and indeed even decline into next year. And that, as I said, will have implications for certain key drivers of growth. One issue in relation to prices I'm just going to talk about in the next slide is to do with the housing market. So in our recent quarterly economic commentary, we outlined some analysis in that market, in that commentary on the housing market, and our belief that in general, given the pace of growth in house prices over the last 2 to 3 years, we now believe the housing market is overvalued to the tune of around 7 or 8%. That means that we expect the pace of house price growth to moderate significantly over the coming year. And that process will be aided and abetted by the further tightening of interest rates, both at the euro area and inevitably at the domestic level. So as we see higher policy rates at the euro area being mapped into higher mortgage rates in the domestic economy, that will have an adverse impact on house price developments in the domestic economy. The next slide, just talk about the overall risks to growth. So therefore, the inflationary pressures and supply chain bottlenecks, clearly, the energy markets and the prospect potentially of rationing of energy products as we move through the next year. Slowdown in global economic activity. So these are some of the key risks that we see hitting the domestic economy, particularly deteriorating conditions in the UK. And I'll talk a little bit more about those in the next couple of slides. Tighter monetary policy, the end of the low interest rate environment that we've experienced over the last period of time. And the humanitarian costs of the war will continue to have fiscal implications for the domestic economy. So those are some of the key risks. And if we now move on to the next slide to look at the particular circumstance of the UK economy, and indeed even yesterday we saw gilt yields shoot up again to rates just before the Bank of England intervention. So clearly the UK economy is not out of the woods as far as the immediate financial market pressures are concerned. But we were concerned and writing about the UK economy even before the events of the 23rd of September when they had their mini budget, and of course the announcements on that day, the fiscal event of that day, triggered a very adverse reaction as far as market conditions were concerned in the UK. So you had a significant increase in borrowing as the markets began to seriously question the implications of the budgetary measures that were announced on the fiscal sustainability of the UK economy over the medium term. And it's now evident that markets are bidding in fairly high interest rates over the coming period of time. In terms of some of the implications of that, we saw sterling falling to its lowest rate vis-a-vis the dollar since 1985. And on the 28th of September, the Bank of England had to intervene to stabilize the pension fund industry because of the declining value of UK gilts. In the next slide, you can see the rapid decline in sterling, both particularly in terms of the US, the dollar, but also you can see it's been falling in relation to the euro as well. It's not just a dollar issue, although the dollar has been appreciating against most currencies in the last period of time. In terms of where Ireland stands in all of this, if we look at the next slide, you can see that in terms of our share of exports from Ireland by trading partners, and this is the merchandise trade in terms of percentage share of total value, you can see that the UK, which is that light blue box there, has been declining in significance in the recent period. So over the last 30, 35 years, our dependence on the UK economy has been declining, but that has been particularly the case over the last 5 or 6 years, and that reflects the very strong pace of growth in the pharma and ICT sectors that I talked about earlier. So you can see that the US and economies like Germany and China are now more relevant to Ireland in terms of our exports than what the UK is. However, and if we move on to the next slide, in terms of the implications of the UK situation for the domestic outlook, the financial sector here is less integrated with the UK since the financial crisis. Most of our financial institutions have deleveraged significant shares of the UK book. So the Irish financial sector is in a much healthier position than it was in 2007, 2008. However, many Irish SMEs are still trading with the UK. We've already seen some financial market implications for Irish institutions with UK exposures in terms of the implications for their share prices, indeed, over the last few weeks. And in terms of any large financial shock in the UK market, it's very difficult to get a true appreciation of the overall contagion effect that may come with that. So clearly, we still have to be vigilant in terms of how difficulties in the UK market could map over into the domestic case. Finally, though, in terms of the assessment of the overall economy, just moving on to the last slide there. So our overall assessment is, clearly we're looking at a deteriorating geopolitical situation that has exacerbated kind of pre-existing inflationary pressures and given rise to concerns about energy security. We do expect inflation now to be higher next year than what we would have previously thought. However, because of the strong surge in government receipts and the low unemployment rate, the government has been in a position to assist those who need it most in terms of the cost of living pressures. We still expect the domestic economy to increase both this year and next year, and that's particularly because of the strength of performance of key sectors such as ICT and pharma, and these have to date remained relatively unaffected by global conditions. In terms of our headline forecast then, in terms of GDP and modified domestic demand, we now expect those to increase with growth rates of 8.1 and 7.5% in the present year. And next year, we do expect to see the growth rate moderate somewhat. So we expect GDP and modified domestic demand forecast to be 4.4 and 2.5% respectively. So with that, I hope I've stuck within my time, and I'm very happy to take any questions that people may have.
Thank you very much for that presentation, Kieran. I very much enjoyed it. So just the first question that's been submitted. In terms of geopolitical events that could impact the Irish economy and could trigger off a global recession, how well prepared would Ireland be to weather a global recession compared to the previous one in 2007?
Yeah, it's a very interesting question. I think there's a number of different facets to it, and without wishing to sound too optimistic and too positive, if you like, I think we're in a much better position in general. I think clearly in 2007, 2008, our financial sector was very, very much exposed because of the bubble that had arisen, particularly in the residential, but also the commercial property market. So we had a financial sector that was very, very vulnerable in 2007. In general, and then when the shock came to the global financial system, our financial sector was particularly impacted by that. And of course, it wasn't just the financial sector; it was the related, issues and concerns that spread throughout the property sector, and the huge influence that the property sector had in the domestic economy. So we were very, very susceptible and vulnerable. We're less so now. Clearly, our financial sector is in a much more stable position. I think it's generally accepted since then. Lending practices have been very conservative over the past period of time. So the financial sector is in no way as exposed as it was. As far as the overall impact on the domestic economy of a recession, clearly, Ireland as a small open economy is always impacted by international considerations. And that is always a kind of a working hypothesis. However, I think it is interesting to note how influential key sectors of the economy have become, in particular, as I said, ICT and pharma. So I think an awful lot depends more on how those sectors perform over the next couple of years. They could continue to perform very strongly, even in the presence of a global recession, in which case the domestic economy would continue to perform quite strongly. But if anything were to adversely impact those sectors, then it would have a very significant impact on the domestic economy. So I think overall, we're in a much better position. We do have a strong, the public finances are in a strong position as well. But again, there is that concern, I suppose, around the sustainability of the corporation tax receipts. But as I said in the presentation, I think the decision to go with a rainy day fund and to allocate funds into that both this year and next year is a prudent step by the government in that regard.
Thank you, Kieran. And says, if peace breaks out between Ukraine and Russia and global energy markets return to normal, would that drive deflation throughout the global economy, and would that create any complications within Ireland?
Clearly, I think most people are obviously are assuming that we're going to continue to have an adverse situation or continuing conflict between Russia and the Ukraine, and that will have ongoing difficulties as far as energy markets are concerned. However, it is a very interesting question as to what would happen if suddenly the situation were to be dramatically resolved in a very short period of time. And I think you would see inflationary pressures ease quite a bit. I don't know whether you'd get to a deflationary situation, but I certainly think you would see the inflation expectations being radically overhauled in that context. And I think even our own expectation of 6.8% next year, that could come down quite sharply if you were to have a very dramatic kind of resolution in that sense. I think the other area which would be interesting is the government has outlined a very significant, substantial package in the budget. That's on the expectation that people will face very, very sharp increases in the cost of living pressures over the next period of time. If those don't come to pass, then the government will have put an awful lot of money into an economy that is performing very, very strongly. Now, typically and ordinarily, we wouldn't be in favor of that because that brings its own inflationary pressures. But obviously, in the context of expected increase in cost of living, the government really had no other option but to do that. However, if those cost of living pressures don't come to pass, then as I say, the government will have pumped in an awful lot of money into an economy that is already performing quite strongly.
Okay, thank you very much. And then very slightly political question as much as an economic one. But in light of recent developments in the UK government and in terms of protocol negotiations, if Ireland was to agree to a hardening of the north-south border, would that have any economic impact within Ireland? Presume they're referring to the Republic of Ireland.
A hardening in the sense of that if we were to see kind of border controls coming in between Northern Ireland and the Republic, if that's the thrust of the question, and I think that would certainly have quite an adverse impact. I mean, I think politically it would have an adverse impact. And also, I think there's been a surge in trade between Northern Ireland and the Republic of Ireland the last couple of years, and I think there's strong evidence to suggest that many businesses in the north are increasingly kind of orientating themselves more towards the south of Ireland because of the ongoing issues around the protocol and Brexit, etc. As far as the UK economy is concerned, and those businesses that still want to kind of have a foothold into the European market, then it's a logical step to take is to do so through the Republic of Ireland. So I think any hardening of the border would have an adverse impact as far as those trade flows are concerned. And so clearly, I think, it's in everybody's interest really to ensure that, whatever, there seems to have been some thawing in the relationship between the UK and Irish government even just over the past couple of weeks. Hopefully that will lead to, substantive negotiations as far as the protocol are concerned, and that difficulties can be resolved through negotiations, because I think the protocol arrangements clearly seem to have benefited Northern Ireland when you step back and look at the data in the aggregate. I think it's benefited the economy in the Republic to have greater integration with the North. And so I don't think anybody really wants to see a reversal or a hardening of the border between the two different economic entities, if you like, on the island.
Okay, thank you very much. And I think there's no more questions. I might just ask one of my own just to finish off, Kieran. In terms of, I very much appreciate how difficult economic forecasts are, and I suppose there seems to be a requirement to produce a single point almost forecast often. Like, what would you, I suppose, realistically, what would be in your view, the probability of negative growth in, let's say, in 2 years' time in terms of
I think what could drive that would be clearly a very adverse global recession. If we continue to see very sharp upward movements in inflation, and as a result, we see the central banks, both the ECB, both the Fed in the United States and the Bank of England, indeed, if they continue to increase interest rates, and if we really move into a new era of much higher interest rates, then I think that could have a big dampening effect on global economic conditions and indeed on domestic conditions here. I think going back to the presentation, and it's one of the points that we've noted in the commentary, is the huge, the increasing reliance of the domestic economy on pharma and ICT. These really are driving growth across value added, across employment generation, across the corporation tax receipts, and indeed across trade in the domestic economy. So if either of those sectors were to experience a fairly sharp shock globally over the next year or so, then I think it would have quite significant implications for the domestic economy. So I think those are some of the factors that you could that you would need to see happening, if you like, in order for the domestic economy to register negative growth.
Okay, thank you. And I think as there are no more questions, I'd very much like to thank you for your presentation. I think it was extremely insightful and extremely enjoyable. So thank you very much, Kieran.
Sure, thank you.
Our next speaker then is Malcolm Melville of Schroders in London. Malcolm is the co-fund manager of a number of commodity funds. In addition, Malcolm is also responsible for chart and sentiment analysis across the whole emerging market debt Absolute Return and Commodities Group. Malcolm has also previously worked for Caxton Europe Asset Management as a portfolio manager responsible for Global Macro Fund, as well as previously working in Forces Investment Manager as a currency strategist. So I'd very much like to welcome Malcolm to present to us today. And just to remind people, if they wish to, they can raise a hand during the presentation or continue to use the Q&A function as well to ask any questions during it, which then we picked up at the end. Okay, over to you, Malcolm.
Great, thanks, Sarah, and thanks very much for the opportunity to talk to everyone today. So the focus of my presentation today is going to be the outlook for commodity markets. First bit of the presentation is going to focus on commodities in general, the bigger picture, the outlook for the asset class, and then we'll finish with a few slides on looking particularly at the energy market and where we think oil prices might go over the coming months and years. So if we go to the next slide. So the funds that Schroders manage, the commodity funds that we run, they're indexed against the Bloomberg Commodity Index. The Bloomberg Commodity Index has three sectors: energy, metals, and agriculture, and it's pretty much split 1/3 in energy, 1/3 in metals, and 1/3 in agriculture. Now, we change those weights in the funds depending on our views, but for our clients who are investing in commodities through the Schroders funds, you get a broad exposure to various commodities. So in terms of what we're thinking on the different sectors at the moment, I guess the energy sector is the sector we're most constructive on. We'll go into a bit more detail on that later in the presentation. The metals area, I have to say we're much more cautious on. The two real driving factors for that is concerns about the Chinese property market and ongoing COVID restrictions in China, and the weakness we're seeing in terms of European demand, the weakness in metals demand out of Europe. So we like energy, but not so much metals. So in the portfolios, we have an overweight, more exposure to energy and less exposure to metals. And in the agricultural space, there are pockets which are very interesting. I think particularly the wheat market, which is in a significant deficit and is very reliant on that export deal, continued export of wheat from Ukraine, which is in itself, that deal expires on the 20th of November unless Russia decide they want to keep with that deal. And so that would probably be our key pick in the agricultural space. If we go on to the next slide, one of the questions we get asked recently is, it's interesting, commodities have been rallying for the last 18 months, 2 years now or so. Commodities as an asset class is up about 20% this year, despite the recent falls. So in the summer, we've come down about 18%. And the question we often get asked from investors is, well, is that it for commodities? Was it just a mini cycle, COVID-induced mini cycle, recovery cycle? And we don't think so. We think we're at the start of a longer term trend higher in commodity prices. Now, every cycle is different in the commodity space in all markets. But if you look at here, this chart shows you the evolution of commodity prices from 72 to 1980, that kind of 70s bull market in commodities. And you can see most years you had a meaningful correction lower in commodity prices in the region of 10, 15, up to 25%. So the pullback we've had in commodity prices from the high this year has been just over 18%. As I say, it still leaves commodities up around about 20% for the year, which compared to other asset classes is decent returns. But I think corrections within a bull market, a long-term trend, are completely normal, and it is our view that that's all we've seen so far. So the next few slides, if we start on the next slide, our focus is going to be really, why are the key reasons we think commodities as an asset class can perform well? And the first reason really is we think commodities are cheap, both on an absolute and a relative basis. So on this slide, what you can see is the performance in the blue line of the commodity, a broad commodity index, versus the S&P 500 going back to the late 60s. And you can see when the line rises, that's commodities outperforming, and when the line falls, that's commodities underperforming. So the last proper commodity bull market we had was 1999 to 2010. That was very much a China-led commodities boom. And since 2010, really until a couple of years ago, commodity prices have really fallen very hard, especially relative to the S&P. And you can see that outperformance we've had in commodity prices over the last 18 months, 2 years, really barely shows on this chart. And I think that really highlights the level of underperformance. If you think about it, equities have been rallying up until obviously this year for 10 years, bonds have been rallying for 30 years, and commodities have been falling pretty much for the last decade, especially on a relative basis. And there's a couple of similarities that's worth highlighting between now and previous commodity cycles. And a precursor we see to many commodity cycles is a long period of underinvestment in productive capacity. So bear markets in commodities absolutely kill investment. Excuse me, and that's what we've seen. The fall in commodity prices has really made it very, very difficult over the last decade for companies to invest in new productive capacity. And that lack of investment sets the stage for when you get a normalization of demand, which is what we've seen in the last decade or so, in the last 2 years or so, you get a normalization of demand, that sets the stage for commodity prices to increase. The second similarity between this cycle, we think, and previous cycles is the CapEx boom. Now, I'll talk a bit more about this later, but this CapEx boom is going to be very much focused on climate mitigation spending, whereas the previous CapEx boom was very much China-led. The third similarity I'd say would be high equity valuations. And the fourth similarity I would say would be geopolitical supply shocks. And also the last one would be inflation. But there is a number of key differences as well, and that's what we'll focus on later, is the role that ESG considerations and climate mitigation policies are having in impacting both the demand for commodities, but also the supply for commodities. So the first point I would make is that on a relative basis, commodities are still very cheap, especially compared to US equities, despite the outperformance of the asset class this year. On the next slide, I think it's worth making the point that commodities on an absolute basis are still very cheap. On the left-hand side here, we have CRB, a broad measure of commodities deflated by inflation, and you can see the rise in commodity prices recently. But relative to history, commodity prices are not high. And on the right-hand side of this slide, you can see the current commodity bull market, the current appreciation we've seen, plotted versus the two previous long-term cycles up moves in commodity prices, the 1970s and that China-centric commodity boom 2000 to 2008. And you can see while commodity in absolute terms, the price performance has been greater, in terms of duration, the commodity cycle we're currently in has only just started. So on an absolute basis, commodity prices remain cheap despite the appreciation in price we've seen over the last 18 months or so. And on the next slide, this is our attempt at Schroders to model commodity prices on two vectors. One is the current price versus the historical price on the y-axis. And you can see anything above zero, which kind of reiterates the point made in the previous slide, anything above zero suggests that the current price of that commodity relative to its history is still low. And on the y-axis, on the x-axis, this is our Schroders commodity model, where we model the supply and demand balances for a number of individual commodities. So anything which is in that top right-hand quadrant, we think is both cheap, but has attractive supply and demand characteristics. So you can see US natural gas, copper, Brent, heating oil, aluminium, all fit within that quadrant. But I guess the important thing is that the number of commodities that are still cheap relative to their long-term history. So we move on to the next slide. I wanted to address the second reason why we think we're in a long-term structural uptrend for commodities. So the first one was they're cheap. The second one is we do think on a global basis, we're a much more unstable world than we have been. If you compare the 1980s and the 1990s to where we are now, 1980s, 1990s, low debt to GDP, low stock market valuations as a percentage of GDP, manageable deficits, and a geopolitical environment which was very much focused on having your production in the cheapest area and just-in-time delivery. Well, how does that compare to where we are now? High debt to GDP ratios, very high stock market valuations versus GDP, although clearly that's been correcting over the last few months, and very high government deficits. And we are in this geopolitical world where, particularly driven by COVID, but also driven by the Russia-Ukraine war, and I would say generally deteriorating relationships, whether it be, for example, in the oil space between OPEC and consumers and the main consuming nations, where the idea of just-in-time delivery and relying on overseas for overseas production for your commodities, for your key supplies, is kind of going out the window. And the idea of reshoring, bringing your production online, you see it in the US, especially now, things like chip makers, but also you see it in the commodity space as well. I think the third difference is that also now we have very high property values. Certainly, maybe not so in Ireland. We saw in the previous presentation slightly overvalued, but maybe not as much as in the past. But globally, I would say, I think the property prices are very high. And that lack of stability in the global financial system means that you're going to have much more heavy and permanent policy intervention from both the central bank and on the fiscal side. So I thought it's very interesting in the last few days, we've seen Germany announce a 200 billion energy bailout for consumers and businesses for the German economy, 5% of GDP. If you cast your mind back 10, 15 years ago, the idea of a government announcing a 5% fiscal package, I mean, that would just be absolutely normal. Fiscal interventions, fiscal policy cuts used to be 1, 2, 3, 4% at the most. And now we're regularly getting 5%. You think about what happened in the UK recently, the mini budget, which wasn't so mini, the impact that's had on the fiscal accounts, and then the subsequent policy reaction we've had to have from the Bank of England to stabilize the gilt market, really just highlights to me how unstable that environment we're in. And I think in that unstable environment, with increased policy intervention, you're likely to be in a higher inflationary environment. Now, I don't think you have to think inflation is going to be trending higher forever. Our view is that we've had an initial move up in inflation. Now, it could well be over the next few months with the recessionary pressures that inflation comes back down. But the question for us is that, are we going to be in an environment where inflation goes back to trend, and this was a blip, and you get inflation back at that 2% central bank target? Or are we going to be an environment, because the financial system's so unstable, that as soon as economies start to slow, interest rates will turn around again. So inflation will go from 8 back to 4, but still above the target, and then pick up again. And we go to this new era where inflation sits in that higher band. And in that environment, commodity prices tend to do well. If we jump forward 2 slides, please. Yeah. Excellent. Yeah, you can see how commodities perform in an inflationary environment. So what we've done here is look back to 1973, and we put 2 areas here. One is when inflation is above 3% and rising, and one is when inflation is below that 3% band but rising. And you can see in those environments, commodities tend to perform very well. Above 3 and rising, commodities on annual in that sample, and we have to say there hasn't been that many years really, but we had the 70s, commodities have performed very well. And interestingly, in that environment where inflation is above 3 and rising, you can see on the left-hand side, US equities tend to deliver negative returns. So it's no great surprise to us that we've been in that environment where inflation has been high, so commodities have performed well and US equities haven't. That poor performance of equities is what you would expect in that rising inflationary environment. But commodities really is the standout asset class, and that's pretty much what we've seen over the last 18 months or so. So we really think that we are in this higher inflationary environment, which is conducive for commodity prices to normally appreciate. The third reason on the next slide I wanted to highlight, and I think this is really, to me, if you take one thing away from this presentation today on commodities, the impact that climate change mitigation policies is going to have, or we think is going to have, on commodity prices for the next decade is really, really absolutely important. So in a normal commodity cycle, what would happen, as I'm sure all of you are aware, prices rise, it becomes profitable to seek new investment. There's a very long lead time on new investment in commodity cycles, whether it be in the energy space or in the base metal space. It takes years and years, but those projects get sanctioned and you have visibility down the line of increased supply of commodities over time. That is not what we're seeing at the moment. So the energy transition has two impacts on the commodity space. One is increased demand. Demand will accelerate. Energy transition is absolutely key to the demand, long-term demand and increased demand for many base metals. You think about your electric cars, you think about solar, you think about wind, you think about all the charging infrastructure. It's very metals intensive. So the energy transition policies we're seeing increases demand for many key commodities. But at the same time, it reduces supply. So take an example recently we saw this week, Munich Re announced that from April next year, they will not invest or insure any planning, financing, construction, or operations of gas or oil fields globally. Now, historically, Munich Re has insured 10% of all energy, fossil fuel, oil and gas projects. And they're pulling away from the market. And the reason they're pulling away from the market is because, I mean, there's many reasons. You have to see exactly what their reason, but it is that global theme of moving away investment and capital from fossil fuel investment. And there is this mismatch we have at the moment between the commodities that we need right now and that long-term goal of energy and transition. And so you have that push and pull in the market, increased demand, reduced supply, and that is breaking that link that you would normally have between higher prices and the supply response. And that can be seen on the next slide when we look at the investment you see in different sectors. On the left-hand side here, you can see the major integrated oil and gas companies, their capital expenditure. So oil prices, $95 a barrel, recently got to 100 in the summer. The last time oil prices were at this kind of level was 2013, 2014. Capital expenditure in new projects, which is that upstream bar, that blue bar, was in the region of 175, 180, 190 billion dollars per year. Capital investment this year from companies, 75, 80 billion dollars a year. It is massively profitable for these companies to produce more oil, but they're not. They're focusing on diversifying their businesses away to renewables. They're focusing on paying back debt, and they're focusing on paying dividends. They're not focusing on increasing production. And that means we kind of have this bottleneck where we still need these products in the environment until we have that proper transition, but we're not getting the investment in future supply. And on the right-hand side, you can see an example looking at base metals. You can see now the investment in new base metal supply, which is absolutely critical for the energy transition theme, is a fraction of what it was in 2012, 2013, when prices were equally high. So we're really not seeing that investment in that new cycle. And on the next slide, you can see the scale of the increase. This is just focusing on base metals. Let's take copper, the extreme left-hand side. So it's estimated that to achieve the energy transition goals over the next 15 years, you're going to need to see a cumulative $526 billion of new investment in new copper supply to generate that 3 million metric tons more of supply. Now, to put that number into context of that 526 billion of new investment, over the last decade, it's roughly, and these numbers are vague, it's roughly about 200 billion of investment has gone into new copper supply. So we're going to need to see double the amount of capex in the copper space to generate that new supply. And that seems very unlikely to us. So the only way you can really solve that is to have higher prices that eventually incentivize that new investment. And on the next slide, you can look at the scale of the global infrastructure spend that's required. So the commodity boom of 2000 to 2010, very China focused. The bar on the left-hand side, total estimated capex spending in that boom from China, about 25 trillion. Now, there's vastly different estimates on how much investment is going to be needed to get the path of what was 1.5 to keep in touch with those goals we need to. Some of them estimates the number's going to be 55 trillion. The OECD says total infrastructure spend up to 2030 is going to be the region 90 billion. And on the right-hand side is broken down by year. And you can see in these estimates, 2030, in the 2030s, in the region of 2 to 2.5 trillion per year. So that amount of capital is just going to absolutely, really turbocharge that demand for commodities and really dwarfs the total spending we saw in the last commodity boom, bull market. And on the next slide, you can just see a couple of examples in the copper space of that increased demand. So the blue bars are 2020 estimated demand, and the green bars are 2030 demand. And you can see whether it be in onshore wind, offshore wind, hydro, PVs, the use of copper within the energy transition space is absolutely massive, but we're just not seeing the investment in new supply we need to really drive that future supply. The fourth reason I'd like to touch on the next slide is the role that China is going to play in this commodity cycle. Now, China is really an important driver of commodity prices, but not so much this time from the base metals side, but more from the agricultural side. Now, China is in a structural deficit for many agricultural commodities, and they're having to import more and more key agricultural commodities. So the left-hand side of this chart, you can see for soybeans. Now, China's been in an increasing deficit for soybeans for the last 15 years, and the green line is their imports. The middle chart is corn, and again, you can see, having been in a surplus for many years, now China's deficit for corn is growing bigger and bigger. The end result is an increase in imports, and also on the right-hand side for wheat, they're now in a deficit. So China is going to be very important in the evolution of commodity prices going forward, but it's going to be more related to agricultural commodities than base metal commodities as in the past. And the final point I'd like to make is that commodity prices on the next slide have already done very well this year, despite the headwind from a strong dollar. And at some stage, and it's very difficult to call, but at some stage, maybe when the Fed pivots, maybe when the Fed stop raising interest rates so aggressively, the dollar will turn around, and that should provide a tailwind. But despite the strong dollar we've seen, commodity prices have appreciated. So that's not a factor at the moment, but at some stage, we expect a weakening dollar should further support commodity prices. So in summary, just those would be the main reasons I'd really focus on. Commodities are cheap, especially on an absolute, but also on a relative basis. You've got, so commodities are cheap on a relative basis. You've got a much more unstable economic environment now, which is more, in our view, is more likely to be inflationary as a result. And then that third key point, which is absolutely key in my mind, the impact that climate mitigation policies is going to have on both the demand, but also sort of the supply of key commodities, and then the role of China. And I'll just finish off quickly because I know I'm conscious of time, but just a couple of points on the oil market, and then we'll open for questions, if that's all right, Dara. So if we go to the next slide, I just wanted to talk about the oil market. The oil market's been in the headlines recently. Oil prices this summer back to $100 a barrel. First point really is that oil inventories globally are very, very low. The chart here shows you the evolution of oil inventories throughout the year. So dark grey line in the middle of the chart is the average oil inventories you'd expect. And this is the average in 2016 to 2020. The green line is 2020, the big recovery in demand we've seen in the oil space post-COVID, everyone opening up, economies growing, global economy grew up, just over 6%. We started the year in 2020 with a lot, 2021, sorry, with a lot of oil in storage. You can see that green line far above the grey line. But we finished the year with incredibly low inventories as the global economy grew, but we didn't have that corresponding supply for the reasons we talked about earlier. And you can see inventories this year on a global basis continue to trend lower. So the starting point in the oil market is very tight inventories. The next point I wanted to make on the oil market is, on the next slide, is we really are in a very unique situation from the point of view of the Strategic Petroleum Reserve. So the SPR in the US is kind of like the rainy day fund in the US. They've had it now for 40 or so years. It tends to be about 600 to 700 million barrels. And it's really there for unforeseen outages, wars, hurricanes, that sort of thing. Earlier in the year, when US inflation was rising strongly and gasoline prices were very high, the Biden administration decided to release 180 million barrels of oil from the SPR to try and dampen down gasoline prices. Now, you could argue it's been very successful. Gasoline prices in the US went from just over $5 a gallon to about $3.20. They've since come up. But the interesting thing is this supply of oil to the market from the SPR is very much a loan. It's not a permanent supply, because they've said at some stage they will need to rebuild the SPR starting next year or the year after. And that release of 180 million barrels is pretty much done. They've got about 15 million barrels to go, but the vast majority of that release from the SPR is already finished. So it begs the question, if you were to have geopolitical events, unforeseen outages, how can the US respond as they would have done over the last 40 years? Because the SPR is back to the level it was in the 1980s. So it's a big, big change in that balance and that factor in the market. The second element I'd like to mention on the next slide is the role of OPEC, and things are changing very quickly here. You would have seen last week, much to the US's displeasure, that OPEC decided to cut production by 2 million barrels a day. And I think the absolute key here to understand is that prior to the cut, OPEC Plus, which is roughly, if you take all the countries together, accounts for about just over 40% of total oil production globally. OPEC Plus were pretty much running at full capacity. Now, this dark blue line at the top is going to fall by 2 million barrels a day. And one of the key reasons is on the next slide when you focus on Saudi Arabia. I thought it was very interesting that in the summer, I'm sure to have seen Biden went to Saudi Arabia and was asking Saudi Arabia to increase oil supply. But the problem is, in our view, Saudi Arabia is running at maximum oil supply. And if you look at the Saudi Aramco investment plans, there's going to be very little, no new capacity coming from Saudi Arabia for the next few years. So the red line is the production levels that Saudi Arabia were running at last month, just over 11 million barrels a day. And you can see in the last decade, only twice has Saudi Arabia been able to run oil production at 11 million barrels a day. And that was for 1 month on both occasions. Now, under the cuts just announced, Saudi Arabia's oil production is going to fall back to 10.5 million barrels a day and stay there for the next 2 years. And I think in my mind, it's no coincidence they've introduced these cuts at a time when Saudi Arabia production was really absolutely at the maximum of what they've done historically. So the idea that the US has that OPEC and Saudi Arabia have tons of spare capacity and all they need to do is flick a few switches and they can increase oil supply and depress oil prices isn't really there. In our mind, OPEC really is operating at maximum, absolute maximum capacity. And the final chart I'd like to show before we pause for questions is really the role that the US producers. So the US is pretty much the largest producer of oil in the world now that Russian production has come down. But US total oil production is still 1 million barrels a day below COVID levels. So in a way, you could argue that the US administration should be focusing all their intentions on increasing domestic oil production rather than on the Middle East. And the key chart here is on the left-hand side. This shows you the rig count in blue against the oil price. So the rig count, number of rigs that are being used to produce oil being allocated, and you can see they're very closely correlated, as you expect. As the price of oil goes up, it's more profitable. Allocate new rigs, increase supply, price of oil comes down. This time, the price of oil has gone up, as you can see the green line. The number of rigs has remained, it's increased, but it's much, much below where it was in previous oil booms. And that really speaks of the lack of investment and the lack of willingness of companies to put capital to work in long cycle projects when they think, why are we going to invest in projects when everyone's telling us in 10, 15 years time, you're not going to need the oil demand. So we think in summary, the oil market is very tight. Inventories are low. Supply is very restricted. Now, if you have a severe economic recession, oil prices probably will come down. But if you have some semblance of growth next year in the global economy, it's difficult to see in our mind where you're going to see sufficient oil supply to meet that new demand. So we think oil prices can probably rise back towards the highs they were earlier in the year. Now, I'll leave it there, Dara, and see if we have any questions. I think you're on mute. Yeah.
Sorry. Thank you very much, Malcolm. So first question, have you seen companies avoid commodity exposure as a result of their ESG agendas in the last number of years, i.e. oil and energy content?
Yes, we have. I mean, when we speak to clients, there is definitely a cohort of clients who won't invest in commodities at all. They'll just say it's not in our remit. I would say that was more common in Europe than in the US, but actually the more commodity prices have outperformed this year, I say there's been a softening of that, and people talking about, well, maybe you have to have active engagement, and what about protecting our investors from the inflationary elements of commodities? But very much so, there is that element. So yeah, I'd say it's more of a European rather than an Asian or US thing. But yes, some investors do avoid that, and other investors, what they do is, one thing, the conversation we've had with many investors is looking at potential for a lower carbon footprint. So investing in commodities, but taking out that oil element and taking out the livestock element, so which is lean hogs and live cattle. So trying to investors who want an exposure to commodities, but they want it in a format that has a lower carbon footprint. So exclude oil, allocate more to those energy transition metals and to agriculture, but keep out that oil element. So yes, it is definitely a factor in investors' minds.
Well, I won't summarize the question, I'll read it in full. It sounds like investment in commodities, anticipating a rise in prices due to the attempt to decarbonize the economy, may cause an increase in prices prior to the industrial purchase of these commodities to achieve this decarbonization. This would make the actual decarbonization process more expensive for all involved. Given the fact that the extent of decarbonization efforts will depend on total cost, in practice, is it reasonable or moral, or safe for a species, to speculate on these prices?
Oh, that's a very difficult question. We're not making any moral judgment on that's not our role. Our role as commodity fund managers is to look after our clients' money within the commodity space. And I would say it is very much up to individuals and institutions to decide whether they want to allocate to commodities. So that's very difficult for me to answer. Our focus is very much on how these factors are going to influence the price of commodities going forward. And maybe I'm sitting on the fence here, but that's our job, is to look after, for those investors who are happy to take commodity exposure, our job is to manage those exposures as best we can on behalf of our clients. So we're not taking a moral stance about the rights or the wrongs. We're just trying to service our clients best we can.
It's probably just a follow-on for myself on that. Obviously, you mentioned like with investor with an ESG hat on will naturally avoid, for example, the oil markets. Has this particular topic ever come up from an ESG point of view? The notion that investing in metals, for example, would make it potentially more expensive to decarbonize.
Yes, it has. Yes, it has come up to a degree. I mean, it's very difficult. One argument put to us by the other side of the argument is that, well, if you want the world to move quicker to a cleaner energy source, then if you have an environment where energy prices are very high, if you had two environments, one where energy prices are very high or one where energy prices are very low in terms of fossil fuel prices, if fossil fuel prices were very low, maybe there'd be a temptation for many countries just to stick with fossil fuels because they were cheap. There's a cheap alternative and not make the hard decisions about moving that path down of energy transition. Whereas oil prices that are very high may incentivize those to seek alternative sources of energy. But it's a very complicated and delicate argument. And as I say, I think it's very much for individuals and their own organizations to make those judgments. We're not making judgments on that stance. We're just trying to understand how commodity prices might evolve over future years.
Recently, some car manufacturers have solved their supply problems by making direct investments in mining operations. Would you see this as being something that will develop to a significant and material extent within the commodities market?
Yes, I think so. I think that's absolutely right. As I say, I think the focus on supply and securing your supply, your direct supply, is absolutely key. In the geopolitical world we live in, and the tensions you have with OPEC, the tensions you have in Russia, Ukraine, the tensions you have with China, I think more and more companies are absolutely focused on how can they secure these key assets we need, these key metals, whether it be in the energy transition space or you see it on a government level. Many governments want to increase their strategic stockpiles of grains, for example, to ensure food security going forward. So yeah, very much. I think people's mindset has changed completely from 3-4 years ago to now being very much focused on how can we guarantee those supply? What's the best way of managing that? So yeah, I think that's going to be a growing trend of companies taking control of the supply chains and not relying on not making the assumption that there is endless supplies of these commodities that they can just turn to when they want. They want to secure their own direct long-term supplies. So companies making those direct investments, I'm sure that's a trend that we'll see increasing.
And so just a final question from myself. In terms of the recent presumably Russian attack on their own pipelines, is that a signal that Russia does not intend to have a long-term, I suppose, gas supply relationship with Europe if they would damage their own infrastructure?
Yeah, I mean, there's lots of speculation about who damaged the pipeline. I don't think there's probably only a handful of people in the world who really know that. But I think what is clear from that conflict is that the European Union and globally, but particularly the European Union, has made the decision that Russia is no longer a reliable energy partner. And they are doing all they can to diversify themselves away from Russian energy. And I have to say they've done a pretty good job on the Russian gas side. And it looks like if you have a normal winter, then Europe will be okay from a gas supply side, unless the weather's really cold. So I think it would have to be a wholesale change in the Russian regime for Europe to really embrace Russian energy again. It almost feels as though that relationship has been permanently broken and Europe is now seeking alternative sources. So in gas, for example, in 3-4 years' time, pretty much all the gas that they took from Russia, they'll be getting from the US in the form of LNG. So Russia will not be required as a European source of energy if you fast forward 2-3 years' time. So yeah, maybe that is a sign that the Russia, maybe it's Russia flexing its muscle. I mean, who knows the pipeline? But I think so. the strategic energy relationship that Europe has with Russia, unless a significant change, in my mind, has been permanently broken. Yeah, I'll leave it there.
Okay, great. I very much like to thank you for speaking to society today, Malcolm. It was an extremely enjoyable presentation, and thank you very much on myself and behalf of everyone else here.
Great, thanks.
So our final speaker today is Hannah Daly. Hannah is a full professor in sustainable energy and energy systems modelling in University College Cork. Her focus is on modelling and developing sustainable pathways for energy systems, encompassing energy access, climate change, and air pollution. She engages extensively with policymakers, civil society, and academia on these topics, as well as being a lead contributing author to several international energy agency World Energy Outlook reports. She has co-authored many peer-reviewed journal articles and several book chapters and other reports. She also writes a regular column in the time of climate crisis for the Irish Times. Hannah, you're very, very much welcome.
Thank you, Dara, and thanks everyone for coming. I'm just checking you can see my opening slide before I move on.
We can.
Great, thanks. Okay, so in this talk, I'm going to give you an overview of Ireland's carbon budget programme and what the implications of that are for our energy system and fossil fuel. And I took a lot of interest in the last presentation. It has a lot of overlap. And in giving presentations about our climate policy and energy policy, I've come to always kind of ground our situation in the global climate, I suppose, situation. So atmospheric concentrations of CO2 in the atmosphere are at around 420 parts per million now. That is anything that we've, and this is far above anything that we've seen in I suppose the history of the species of Homo sapiens, and it's rising quickly. And I did this, I suppose, to bring it home to my students a few weeks ago when Queen Elizabeth II died. Over her lifetime, the concentration of CO2 in the atmosphere rose by 37%. It's a small concentration in the atmosphere, but it's like I suppose the thermostat dial in a room. And it's still being turned up quickly. And what really brought home to me the climate challenge is that this extremely sharp slope won't stop rising until we stop emitting CO2 emissions entirely, or when CO2 emissions are balanced by sinks. So we've with this global temperatures are very closely tracked the atmospheric concentration of CO2. We're now at about 1.2 degrees above pre-industrial levels, with the impacts being felt very strongly in terms of heat waves, extreme weather events, droughts, and those issues. As actuaries, I'm sure you're aware of the risks in terms of destabilizing various global systems. But onto Ireland's climate agenda and our climate policy. So the history of our greenhouse gas emissions since 1990, I suppose it's interesting that in 2020, it brought us to halfway between 1990, which is often seen as the start of carbon monitoring and targets, halfway between 1990 and 2050. And with the pandemic in 2020, which saw a reduction in emissions of 3.6% in 1 year because of a shutdown in transport, that brought our greenhouse gas emissions back to where they were in 1990. And that sets the stage for our carbon budget programme. So now this is a legally adopted, legally binding target on the government, commitment on the government and of society as a whole to limit greenhouse gas emissions over the next 3 5-year periods. So the first carbon budget is between 2020 and 2025. And following that, 5-year programs to rapidly reduce our greenhouse gas emissions in line with what is required, I suppose, to do our obligation for the climate agenda. So our first carbon budget there is a cumulative limit of 295 million tonnes of CO2 equivalent over the 5-year period, and it's important to say at the outset that there was very large political and societal consensus that this is necessary. So if you looked at the Citizens' Assembly, there was all-party consensus on these carbon budgets. Several political parties were calling for even more stringent carbon budgets. There's large political consensus that we need to stop kind of contributing to the climate problem, but there's very little political understanding or societal understanding of the level of transformative change that's required to actually deliver this level of mitigation. And there's very little political buy-in to, I suppose, stomach those changes that are necessary. And this, for me, is very starkly illustrated when we track 2021 and ongoing 22 emissions. It shows the greenhouse gas emissions are still rising. So recent research that we've done in my group looks at ongoing emissions in fossil fuels in the agriculture sector in 2022. It looks like transport emissions will be around 13% higher this year than they were last year. The power sector is on track to rise emissions by 5 to 8% because of growing high energy users, particularly data centers. Agriculture sector, greenhouse gas emissions possibly flatline, possibly will continue to grow as we continue to intensify dairy expansion. So because now we're in a budget program rather than a target program, the fact that greenhouse gas emissions are still rising mean that we're on the red line rather than the green line. And that means that to stay within the 5-year budget, we'll have to reduce emissions by more than 10% per year, which has never been achieved. Now, Carbon Budget 1 was supposed to be the easy one as we kind of ramp up efforts to Carbon Budget 2. So I think this illustrates the challenge of the kind of rapid and immediate emissions reductions that we've promised, and even the Carbon Budget 1 is at risk within the lifetime of this government in particular. It also highlights that previously we had a policy gap. So we had the policy commitment, but lack of policy. Now we have the policy, but we have an implementation gap. So we don't yet have the policies implemented to actually achieve those targets. So to look at, kind of zoom out again at whether our carbon budget program is aligned with the global climate effort. So what climate science can tell us is what the remaining global carbon budget is to stay within a certain temperature limit with a certain probability. So the Paris Agreement is that all countries will strive to stay well below 2 degrees of warming. A very generous interpretation of that is a 50% chance there in the middle of staying at around 1.7 degrees of temperature rise above pre-industrial levels. Others would go further and say that requires 50% or even more, a 66% chance of staying below 1.5 degrees of warming to stay to prevent tipping points from being destabilized in terms of the destabilizing of the Arctic, of the Greenland ice sheets and Antarctic ice sheets, for example, which will trigger devastating sea level rise. And if we compare what Ireland's fair share of that remaining global carbon budget would be, if we kind of took the global carbon budget and allocated it to every person on a per capita basis and started the clock in 2020, kind of ignoring the historical contribution of different countries to temperature rise, we would get in Ireland a 50% chance of limiting greenhouse gas emissions to 1.5 degrees there on the left, of around 313 million tons of CO2. That is just CO2. This ignores the other greenhouse gases, which would already be nearly exceeded by our Carbon Budget 2 program. Now, if we want to go even further and say we want a 67% chance, a high probability of staying below 1.5 degrees, already halfway through Carbon Budget 2, that would be exceeded. So here we also include international aviation and shipping emissions because those are not included in our national carbon budgets, but they do contribute to our sort of global burden on the climate. Now, if we roll that back a bit and start the sort of clock about what is an equitable share of the global carbon budget back in 2015 when we signed the Paris Agreement, this 2015 base level, you can see that we're very, very close to exceeding even the first level here, the high chance of not exceeding 1.5 degrees. And by Carbon Budget 3, we have passed the 50% chance of increasing 1.7 degrees. So what I'm kind of using this to illustrate is that even though we have one of the world's most ambitious legally binding targets to 2030, that still puts us in a position where it's very likely that we'll exceed our fair global per capita allocation of the global remaining carbon budget. And we will have to, I think, as climate agreements evolve, as the situation with regards to climate impacts evolves, we are going to have to think about long-term negative emissions and carbon drawdown. And I think that's going to become clear in the next number of years. But of course, decarbonizing our energy system at a time when there are multiple threats and multiple vulnerabilities to our energy system is a challenge. So what we call the energy trilemma has never been as stark as it is now. So to ensure a kind of a secure and sustainable energy system, we call it the energy trilemma. We need energy security, so the uninterrupted availability of energy for society, for the economy, because fossil fuels play such a fundamental, or energy itself plays such a fundamental underpinning role in everything that we do. But both, I suppose, the European situation with the invasion of Ukraine and the knock-on consequences for natural gas supply at the European level, but also the threats to our security of electricity supply this winter, which is a separate issue, highlight the vulnerability of our energy system to interruption. And we're in an energy security crisis at the moment. I won't go on about the middle part there, which is energy sustainability. It's clear that our energy system is overwhelmingly fossil fuel based, which is extremely insecure. We're still investing in new fossil fuel infrastructure in terms of demand here in Ireland. We have, we're in 60% of our cars are still SUVs, and around 85% of new cars burn oil. We're still kind of building new homes with oil and gas infrastructure and so on. So we're far on track from putting for our energy consumption on a sustainable, environmentally sustainable pathway. And the third part there, energy affordability, with households and businesses facing crippling energy costs. This third pillar of energy of the energy trilemma is very insecure, and it's worth highlighting that while these three kind of pillars are independent in terms of their impacts, they all have the same underpinning cause, that our society is fundamentally tied up with fossil fuel consumption. They said nearly 90% of our primary energy still comes from fossil fuels. If we had already began the energy transition in earnest a decade ago or 2 decades ago, where we had built a transport system that was less car-based, where we had well-insulated homes, and an economy that was not based on energy-intensive activities or carbon-intensive activities, we would be in a much better position from all three perspectives. So it is that delay that has caused these vulnerabilities, this delay in taking these actions. So to specify where Ireland's greenhouse gas emissions come from, in 2019, around 34 million tonnes came from our energy system from burning fossil fuels. Around 21 million tonnes from our agricultural system, which is based on ruminant livestock, on beef and dairy production for the export market, and then a certain amount, 5 million tonnes, that's mainly from F-gases and from cement processing. These are the kind of key areas that the Environmental Protection Agency looks at in its greenhouse gas inventory. And the energy system there is broken into electricity, heat, and transport, with heat being the main source, so heating buildings and heat for industry. And on top of that, we've got about 3 million tonnes from aviation. That's not counted in our carbon budgets as yet. That is dealt with at the international level. We have a number, uncertain amount of greenhouse gases that are being removed, around 3 to 4 million tonnes every year being removed from the land through certain types of soils and through afforestation. But our sources of emissions from land are actually greater. So we've got a large amount of our grasslands are on peaty soils. And right now the government is updating the inventory, and it looks like the land source of emissions is greater than we originally thought. So the challenge is to reduce these emissions by 51% between 2018 and 2030, and to increase the sinks and to decrease the sources, so that by 2050 we're at a climate neutral, we're climate neutrality. And it's worth pointing out there that while 2030 is the ultimate aim, it is the pathway between now and 2030 that the carbon budgets are dominating. So what I'll share for you is some modelling analysis that my team has done to support the Climate Change Advisory Council in its recommendations for carbon budgets. So we look at the energy system, so at electricity, transport, heat, and industry, and look at pathways for decarbonising those four systems. So we have an energy system optimization model, which I'll show you in a moment, and we model 4 core scenarios representing 4 different pathways for the energy system. So when the energy system is around 65% of our greenhouse gas emissions, I suppose the political negotiations, especially this summer, were around what level of effort the agriculture sector would take, and they ultimately landed at around 25%. And that would require the energy system to reduce emissions by 65%. So this green line here. So we modeled the achievement of these 4 decarbonisation pathways, landing on carbon neutrality or net zero in 2050. And we explored alternative scenarios, whether we could have early action, late action, whether we would have a lower energy demands, this low energy demand scenario, different outlooks for wind, solar, carbon capture and storage, and different kind of levels of optimism about how quickly we could deploy different technologies. This analysis underpinned the technical report behind the Climate Change Advisory Council's work on carbon budgets, and has fed into the government's climate action plan and sectoral carbon budget program. The model itself is fully published, so it's open source, and the documentation paper is available to download. So the model underpinning the analysis is a linear optimization program based on this framework called Energy Systems Optimization Models. It calculates the least cost configuration of the energy system, which meets future energy demands and respecting technical, environmental, social, and policy constraints defined by the user. So unlike the ESRI kind of modeling of the quarterly economic projections, we don't call these forecasts. These are something like a map. It's a map gathering our best assumption about the future to allow us to make decisions and trade-offs about policies, investments in the energy system to meet demands while respecting climate constraints. So given our future projections for final energy demand, so how many houses to heat, how many passenger kilometers, how many tons of cement to produce, given policy constraints such as carbon budgets, given our outlook for technologies, fuels and efficiency, resource availability, such as how much bioenergy can go into the system, and user-defined constraints such as the speed of technology uptake, what the model calculates is the least cost investment and operation of energy system technologies which meet all these requirements at least cost, giving us sectoral emissions trajectories, total system cost, imports and exports, and crucially marginal energy prices there. So the headline insight there is we have to rapidly move away from fossil fuels, starting with the most carbon intensive fossil fuels. So in 2018, around 11% of our primary energy came from coal and peat, that's solid fuels, 34% from natural gas, mainly for heating and electricity. And then the largest share, 46%, was oil, which is fuels our transport system, and equally home heating with natural gas. And to achieve a 51% reduction by 2030, in the huge scale up in other renewables, mainly wind and solar, and bioenergy is required, while at the same time reducing the total size of the pie, so reducing primary energy demand through efficiency and demand switching measures, through starting with the most carbon intensive fuel, getting coal and peat out of the energy system, and then addressing oil, whereas natural gas, as in terms of the share of the energy system, remains relatively resilient, especially in the power system, as it's required to balance wind and solar, and it's the least carbon intensive fuel. So we looked, one of the key outputs of the model is the marginal abatement cost, which represents the cost of mitigating the most expensive ton of CO2 in every scenario for the energy system. And this looks at the average marginal abatement cost in the second carbon budget period in these core mitigation scenarios where we assume, business as usual energy demands, no radical breakthroughs in carbon capture and storage, for example, import of hydrogen, about 75% renewable electricity on the system, which is in line with government targets. And it shows that to get from 51% here in the kind of orange over there to 65% on the right, it dramatically increases the marginal abatement cost of the system. And now in a perfect kind of world, or perfect according to an economist, which is probably not anybody else's idea of a perfect world, but this is the equivalent of the carbon tax that would be required in the model to achieve that level of abatement. And so we also looked at the impact of lower energy demands, so mode switching and transport towards public transport, active travel modes, dematerialization of the economy, so less economic growth, less focused on energy intensive activities like data center expansion, lower heating in homes, a big focus on retrofitting, and a sort of societal mobilization away from high energy intensive uses. That brings down the marginal abatement cost across all scenarios significantly. We also have a tech optimism case, which is the sort of green growth paradigm, where we'd have much greater optimism about the potential rollout for wind and solar. We'd assume that there's breakthrough in carbon capture and storage from 2027, and more than 90% of zero carbon power generation is available to the system by 2030. That again brings down the marginal abatement cost, and then we model both of those scenarios on top of each other, which brings down these figures into sort of more palatable and less sort of fall off your seat levels. But I hope at least that this communicates, especially these kind of core measures, how extremely challenging the transition will be in the coming decade. And I'll look a little bit closer. This is an investment forum. I wanted to pull out a little bit of the investment figures from this to demonstrate the sort of level of investment where in the energy system that requires change. So what we looked at is the average additional annualized energy system cost for various scenarios. First of all, the climate action plan that represents our previous policy, which was to reduce emissions by around 30% by 2030. That was by the previous government. And so in the previous climate action plan, that would have required less than 1 billion in additional investment per year, with a lot of the increase in investment costs being offset by a reduction in the variable cost there, which is mainly a reduction in fossil fuel imports. A colleague of mine, Paul Dean, likes to point out, which I think is very effective, that Ireland imports around 1 million euros worth of fossil fuels every hour. And so we need to switch that energy system from one which is based on high variable cost and fossil fuel imports to one which has high investment cost, building renewables, solar, electric vehicles, wind, retrofitting, quality in public transport systems, for example, but one with low running costs. And so if we look at achieving the 51% target in terms of the annualized cost, that the cost there rises to around 2 billion a year. To achieve that 65% target, which looks like how the target will land for the energy system, that increase rises very significantly, sharply to around 6 million tonnes, and lowers with both the tech optimism case and the lower energy demand case. So the lower energy demand case requires fewer cars, fewer power plants. It just shrinks the whole size of the energy system, which is why we see a reduction there in that scenario, especially out to 2050. But annualizing these costs doesn't really show the magnitude of the upfront investment cost that's required by this. And if we click through these again, as I said, we need to move from an energy system that is based on high running cost, low capital cost, to one which is the reverse, a high capital cost energy system, but low running cost. And for this next decade, we're going to have both high investment costs and high running costs. As that transition messily unfolds. And here, if we look at this third chart here in the bottom left, this shows that to achieve the 65% target, that high additional upfront investment cost by sector is really up at around 14 million a year, when that additional investment is mainly required in the transport sector as we electrify, in the residential sector, as we both electrify and make it far more efficient, and also in electricity and supply, and a certain amount there in the enterprise sector again. And again, those costs lowered when we assume that there are greater kind of levels of technology available to us, and lower again when we have low energy demands. And I think, just to reiterate this slide again, what's not just important this decade is to deploy these technology solutions which already exist in the market, which are already mature and cost effective. But this decade is also, we're required to mobilize resources in order to achieve this carbon drawdown before 2050. And I think it's very clear from the global climate situation, the ever-shrinking global carbon budget, that we'll have to think not about net zero by 2050, but carbon drawdown, that's net negative emissions, well before 2050. And that requires a really fundamental long-term shift in thinking at policy level. So if you want to stop emitting fossil fuels emissions by 2050, You need to stop investing in any new fossil fuel consuming equipment before 2030 because of that lifetime, unless you want stranded assets. But also there's that long-term vision to achieve carbon drawdown. We also need to restore forests and wetlands, and that requires a very long-term thinking in terms of how we use land to rehabilitate nature, because we have a parallel biodiversity crisis. And it's clear that we need to mobilize private and public sector innovation to solve these hard to abate decarbonization. So long-term, long distance transport, long scale energy storage are two of the key challenges. And then to reorientate planning to enable that low energy demand vision, to have these low carbon lifestyles while maintaining well-being. And these are my kind of insights on the Irish situation. But I also wanted to share some analysis from the International Energy Agency, where I previously worked, who developed this global pathway to net zero by 2050, which was a very landmark report before COP26 last year. And this slide, I think, illustrates very well, and it's in parallel for Ireland. I want to make a similar graph for Ireland, but this is the IEA's pathway to net zero at a global level. And it shows that there's really no silver bullet solution. That shouldn't be a surprise. It requires this huge rainbow of solutions, which start with a zero carbon electricity system, with renewables, with wind and solar being the backbone of the electricity system. There in the green, it's the biggest wedge in terms of carbon savings. Also some biofuels, efficiency, achieving huge savings here in the yellow area. Hydrogen being a important component for these hard to abate sectors, and to balance wind and solar. Demand shifts here in purple, so what they call behavior. I'm not a big fan of the term behavior change because it assumes that we're all behaving badly, but it's really about structural shifts in how our built environment kind of induces energy demand. And finally, some carbon capture, use and storage. So without any one of these solutions, we won't reach net zero. But it's renewables and electrification that make the strongest contribution to achieving those emissions reductions. Also, here is a very kind of influential graph that the IEA put out in this report, that which looks at near-term milestones to get on track for long-term targets. And it shows the sort of starting from 2020 right out to 2050, it is these milestones that are necessary to hit in order to get there. And you'll see from this chart, it's as much about what you don't build, what you don't invest in, as what you do invest in. For example, in 2020, the key thing there is no new unabated coal plants approved for development, and no new oil fields and gas fields approved for development, and no coal mine extensions. And that really hit big headlines when that came out last year, because the IEA said to get to net zero, we don't need any new oil and gas field development. But the problem, as highlighted by Malcolm, the last speaker, is that whereas we're restricting supply, but we have to in parallel restrict demand and invest in the alternatives. And if we don't do that, then we're going to have we're going to put a severe pressure on the cost of energy. And to do that, we need to build zero carbon ready buildings, achieve electrification of transport as soon as possible, and to deploy wind and solar. And this graph over here illustrates at the global level how annual energy investment needs to quadruple over the next decade to 2030 in clean energy there, especially in developing countries. So we need to drive a historic surge in clean energy investment, which is mainly underpinned by private sector finance, which is mobilized by mobilizing the capital for large scale infrastructure, and again electricity generation, infrastructure, and end use such as transport and buildings being the key source there. What the IEA, another really interesting finding from that IEA report, is that in conjunction with modeling with the IMF, they found that this huge investment kind of drive creates millions of jobs, clean energy jobs, which are high quality jobs across the whole world, and drives an additional GDP growth of 4%. So the global GDP is 4% above what it would be without this investment in 2030, which I think is a very positive narrative that goes away from a lot of this negative framing of the energy transition as being one that is costly. It is clear that it's the status quo that is very costly, in fact. And before I conclude, I think here's another slide from the IEA that if we look at the energy savings or the emission savings that are to be achieved this decade, it is mainly solutions which already exist. And the main challenge, as I said, is deploying those solutions. We already have over half of the solutions to get to net zero. But in 2050, of the solutions that are presented there in that waterfall graph, still nearly half are under development. These are technologies that are not yet at the market. And right now, unlocking that next generation of low carbon technologies requires a huge amount of R&D in this decade, particularly in advanced batteries, to ensure that we can translate that or store that that huge amounts of wind and solar that we're building to times when the energy system needs it, to hydrogen-based steel, to direct air capture, and hydrogen electrolyzers. So those technologies, they make really important contributions to the reduction of CO2 emissions by 2050, and not just through research and development, but through deployment. So we need to bring these technologies to market as quickly as possible, as we have with electric vehicles, with wind and with solar. So I'm really looking forward to the Q&A session, and very happy to be in touch on any of those questions. So thanks a lot.
Thank you very much, Hannah, for the presentation. So the first question from myself, in Malcolm's presentation, he outlined that the investment needed to transition to a net zero economy globally will, in his opinion, drive an increase in input costs. And I guess you yourself outlined like the scale that investment is needed. Has the increase in costs been something that's kind of brought into the modelling, or is that something that could potentially catch out? Well, one, do you actually agree with that view, I guess, first of all? And if you do, is that something that's included in modelling?
Yes, so the recent inflation and an increase in commodity costs have led in. No, so we haven't included the last year's inflationary pressures on the sort of components of the energy transition, I suppose. But neither have we included as well the except in sensitivity scenarios, the increased cost in natural gas. So we are looking at this, but we have looked at, I suppose, following the invasion of Ukraine and the skyrocketing natural gas price. What we find is the net cost, the net additional cost of the energy system transition is a lot lower, because the baseline investment in fossil fuels and the baseline cost of fossil fuels is a lot higher in a high fossil fuel price world. So there's an additional, I suppose, justification for that transition because of high natural gas prices, especially.
Okay, thank you. One of the questions came in. Thanks for the great presentations. For Hannah, what are the top 3 things we as individuals or companies can do to facilitate the transition?
Yeah, individual. So I get the question a lot. A student asked me yesterday, should he be an engineer or should he be an activist? And I suppose I told him it's well, first of all, at the personal level, don't, a lot of people here will have, sort of high income jobs with the ability to stop driving fossil fuel cars, ability to retrofit their homes and get off heat pumps, get off fossil fuels as quickly as possible, and make that, I suppose, that a very visible transition. Better to have an e-bike, but if not, get an electric car if you don't already, and put solar panels on your roof, because the sort of spillover effects in terms of the kind of that social spreading effect is actually very strong. So you'll influence a lot of others with your personal actions. Stop eating meat if you can, and dairy products. Those things are also a big impact on your personal carbon footprint. Flying is a huge factor as well. Of course, it's very hard to stop flying if you've got family abroad or if work brings you there. But sort of like non kind of compulsory flying is a big thing, and to do these things visibly. But of course, I think there's a move away from talking about your carbon footprint to your carbon shadow, which is the sort of impact of your whole life's activities. You know, what do you read, what do you listen to, what do you talk about with your friends, what kind of job are you in? And I suppose it's about bringing these conversations to the normal dinner table, to normalize these conversations, and bringing climate in as a topic in every conversation. It's not a niche sort of environmental issue. It's really an everything issue. And I read an article recently that was very influential. It was that, you know, every job is a climate job. You know, whether you're whatever area that you're in, it has some there's whatever organization that you're in terms of the organization's own operations, or whether it's, you know, working with fossil fuel companies or involved in greenwashing, for example. That's a huge thing. So yeah, lots of thoughts about individual actions.
Thank you. I suspect you might have heard this question before in one form or another. Is the discussion around reducing emissions from Irish agriculture missing the point that our method of production is a much lower carbon intensive system than alternative locations? Should production not be encouraged in the most efficient location methods rather than limiting production in Ireland, which will invariably be made up in less efficient locations?
Yeah, I frankly, that argument unravels very quickly when you really poke into it. First of all, the evidence that the Irish agriculture or the livestock industry uses to kind of establish that it is low carbon is based on 20-year-old data nearly. And it's not a you know, inevitable. Like our main competitors, for example, in the dairy industry, is not Brazilian deforested dairy. It is, for example, New Zealand, in terms of, let's say, infant formula. New Zealand has a lower impact livestock system. So a lot of our competitors can be lower carbon than we can. You know, second of all, that carbon leakage argument assumes that we are meeting our own climate goals and other countries are not meeting their climate goals. We have not met our 2020 targets largely because of an increase in agriculture emissions. So when you're talking about climate leakage in the agriculture system, I think it's often you know, more appropriate to think that there's actually climate leakage into Ireland, because countries like the Netherlands, which have imposed stronger environmental kind of quotas on their livestock industry, are starting to build dairy factories in this country to sort of because we haven't yet imposed, let's say, nitrates limits, even though we're exceeding our nitrates derogations. So my column in the Irish Times from not last week but previous month dealt with a lot of these things. And when you have the Minister for Agriculture going to, you know, on a trade mission in the last number of weeks to East Asia, promoting premium beef and premium dairy products in diets which don't include those, it's clear that those sort of arguments are completely intellectually disingenuous.
Thank you very much. I have two kind of related questions. If I just ask them both, and you can tackle them rather than repeating them. First, given the scale of the carbon reduction challenge and the realization of the fundamental importance of energy resilience and security, what is the potential role that nuclear power can play, given the obvious advantages over variable low carbon energy generation, i.e. solar or wind? I guess very similar one was nuclear considered as part of the modelling work carried out?
Yeah, so thanks for the question. It's another really important one, and it might just go. I don't want to talk about my column all the time, but last Thursday I had a column about the carbon budgets, and there was a similar. There was an article on the same page, which was that by William Revel, that like Ireland should just bite the bullet and go nuclear. And I think, you know, it's very important to consider all options. And I'm technology agnostic myself. I think the phase out of nuclear in Germany and other countries is kind of bizarre and harmful, for example. But you have to look at both the timescales involved and the technical suitability of the technology for the Irish energy system. So first of all, the existing nuclear plants, you can only build them in like very, very large sizes, like Money Point coal power plant size. Those are not technically compatible with an energy system that's already very renewables based and is projected to be extremely variable. So you need the complement to wind and solar renewable energy is something that is dispatchable, something that's very, very agile and dynamic. That is not what nuclear is at the moment. And second of all, the timescales involved. I mean, you're talking 15, 20 years in the future that any nuclear plant could possibly come online, by which time we'll already have decarbonized the electricity system. Third point, there's this new generation of nuclear reactors called small modular reactors, SMR, and they have the potential to be these kind of both kind of flexible, dynamic, and also less expensive because they can be built sort of in a modular way in a factory, brought in and assembled. They're still at theoretical level. We don't know how much they'll cost. We don't know how much they, you know, what the timelines involved. If SMR becomes sort of economically feasible for Ireland in the next decades, I say go for it. But right now we need to focus on what we can deploy, which is wind and solar for the electricity system as quickly as possible, and plan for technologies that exist that complement those, which is hydrogen electrolyzers, low carbon gas, batteries, and demand response. And there's a great letter in the Irish Times today actually about that exact question.
Okay, thank you very much. Do we have a rough approximation of how much carbon output would be prevented, if any, by back office employees working from home rather than returning to the office?
I think it's a good question. We do have estimates. So commuting is responsible for about 40 to 50% of passenger transport emissions, which are about half. So, I mean, you know, about, let's say, 2 million tons a year would be from commuting, I would say. But we have to be very wary of the backlash effects. So there's the reduction in car transport emissions. I know when I work from home, I'll often drive to the beach for a swim, or I will, you know, do some extra traveling that day. People tend to have a fixed sort of travel time budget, and they'll use that travel time to do something else. A reduction in traffic from people working from home will disincentivize public transport, because it will, you know, people will take to the car more. And also, I think I remember kind of a few months into the pandemic, as people were kind of getting used to working from home, one of the property supplements of the Irish Times, the headline was, I think, 50 properties within 50 minutes of the M50 or something like that. People are moving out, and so if they only have to go to the office 2 days a week, they'll be less inclined to live in, you know, close to the office. They'll use that extra travel time to sort of drive a longer distance by car. And so, you know, there's the sort of immediate effects. I think the most important thing that a workplace can do is to is not working from home, but put in place sustainable travel alternatives for the employees, and that includes, unfortunately, ending free workplace parking. Sorry.
So I've noticed actually that we have a hand up, so I apologize to Finian Rafferty if this has been up for a sustained period of time. But Simeon, is it okay to share, have Finian speak? I think Finian appeared but was muted, so I'm not sure if he's speaking.
I think it could have been an accident.
Oh, okay, well, these things happen. And sorry, so just recently, in terms of like the recent budget, is the attempts by the government to ride out higher energy costs actually totally nonsensical? Surely higher energy costs should lead to people naturally reducing their carbon footprints.
Yeah, it's really difficult. That, like, if you kind of think of all of our energy consumption habits, there's if you have two axes, you have you know, I suppose discretionary energy use, which is not necessary. It's sort of just wasted. It's, you know, turning the heat on too high. It is driving a fossil fuel vehicle when you can afford to not drive it. You know, flying to London for a weekend. There's sort of these discretion, and then there's energy that is absolutely fundamental. It's energy for cooking, for getting your kids to school, and so on. And at the same, there's another axis. There's people who can afford to transition both their sort of discretionary energy expenditure and their fundamental, and there's people who can't afford that. So policy has been largely giving blanket subsidies to energy, to all energy, for everybody, and the most important invisible subsidy that the government has given is through the reduction in excise duty on petrol and diesel. So remember, we're also kind of, even though petrol and diesel prices are still almost up at the 180, 190 level, they're still artificially decreased because of this reduction in excise, which is a regressive activity, I think, for the government. And they've been giving kind of these energy blanket energy bills. Now, what the challenge is to target policies so that people who can afford it put on solar panels, do retrofitting, buy EVs, take a bus to work, but not so much that people who don't have any discretionary funding or discretionary income are kind of go through hardship because of an increase in energy prices. It's very hard for government to target these households because we have very poor data on these things. So in Ireland, the government doesn't really know or doesn't have a good grasp on both what household energy needs are and what the household's ability to pay for energy or pay for energy transition measures. What I will say is that I think that the retrofitting program has been very well designed. There's free retrofitting for energy poor households, 80% funding of attic insulation for every homes, and then for homes that let's say the larger higher income homes, there's a 50% subsidy for doing deep retrofit to get off heat pumps. So that is a particularly well designed, I think, measure, and I think the government will have to start literally going door to door to offer people to start putting in insulation.
And a final question from my colleague Rob Meany, which perhaps shows your level of faith in humanity to do the right thing or not. Would you buy a house by the sea in Ireland, say within 5 meters above sea level?
5 meters, you're probably safe for 5 meters. I think it's about the I think it's about the kind of surrounding infrastructure that would be problematic, and whether the area would be threatened by erosion. Not my expertise at all. So I personally probably wouldn't, but that's not my field of expertise. There are maps that show sea risk flood areas. So our major cities are a major threat of sea level rise.
Okay, guys. I think that's the end of our questions. So I'd like to thank Hannah and once again the other presenters for, I think it was very, very interesting presentation, very interesting talks. So I think with that we'll bring the forum to a close. Thanks presenters again, and thanks to all the attendees also.
Thanks, Dara.